Hello, everybody. This is Chris Schwego with Chris Connects, the company that hooks you up with passive income opportunities. Hey, everybody, welcome. Thanks for joining here. I just wanted to talk about some of the changes that have been happening in the world of real estate. One thing that's nice about real estate most of the time is that it happens very, very slowly. You can see markets change over years, not months, not weeks, not days, but that's happening now. Now we're seeing changes quite a lot. Interest rates changing monthly, quarterly, jumping up 25, 50, 75 basis points. Appreciation is happening all over the place. People are moving all over the place. There's a whole lot happening. This sleepy little nice asset class, if you will, just got a whole lot more exciting. So, we're going to revisit some of the fundamentals of real estate investing. Real estate pays you in five ways, and typically those ways were in order of importance: cash flow, loan paydown, tax benefits, appreciation, and hedging inflation. So, we'll tackle each one of those separately now and talk about how the current environment is changing how those fundamentals are. Hopefully, this will help better prepare you and make you a smarter investor moving forward in this environment. So, first of all, cash flow. This is by far the most important aspect of real estate investing. If you get everything else wrong, but you have cash flow, that's fine. And the reason that's fine is because you will still control the asset. The way you control the asset is that your income is greater than your expenses. It doesn't matter what happens in the market. It doesn't matter what happens in micro or macroeconomics, as long as you have your cash flow right. Again, cash flow is basically net operating income minus your debt service. Net operating income is your income minus your expenses. So your income is generally rent. Sometimes it might be other income like laundry, parking, pets, things like that. So it's your income minus your expenses. Expenses being insurance, expenses being property taxes, landscaping, exterminator, garbage, sewer, if you're paying any of those utilities, repairs, all that kind of stuff. So net operating income, again, is your rent and other income sources minus your expenses. That is net operating income, and minus debt service equals your cash flow. Normally, debt for service was relatively easy to figure out, but that is changing quite a bit too. Let's say 2 years from now, or I'm sorry, 2 years ago, typical investor may pay 4.5%, 4.5% interest on their loan. Now we're looking at 6.5. I even was quoted earlier this week, almost 7%. So that changes quite a bit. Also, what changes that debt service is the cost to borrow. The cost at which you're borrowing and how much you're borrowing changes. So in 2019, the typical price, the median home price in the United States was $300,000. At 4.5% interest rate, that's $1,216. So $1,216 of debt service per month. And you could get up to 80% loan to value. That's excellent. That means that you're able to use more leverage. So on a $300,000 home, you only have to bring $60,000 to the table. That's great. Takes less money, you can leverage more, and you're in a great position there in terms of boosting your return on investment. Nowadays, what I'm seeing is the median home price is now $430,000. Let's say 400,000 just to make the math easier. $400,000 instead of 300,000 just a few years ago. And now I'm getting quoted at 70/30 loan to value ratio. That means you can only get a loan for 70% of the cost of the property. So if the property is $400,000 and the loan to value is 70/30, that means you can only get a $280,000 loan. So you'd have to bring 30% to the table or $120,000. Now, some would argue that that's a better position to be in anyway. 30% down means you're less likely to lose the house if there were to be some sort of economic downturn. However, what that means is you do need to bring more money to the table and you're able to use less leverage. So you'd have to bring $120,000 to be able to purchase with a down payment a $400,000 property. And at a 6.5% interest rate, that I did a little math here beforehand, that's 1,770. So it's $550 more that you're paying in a mortgage. Your debt service is $550 more per month. That impacts your cash flow quite a bit. Absolutely. So the margins are getting squeezed, tightened. There's less cash flow there. So what that means is your net operating income minus debt service is getting tougher to manage. Now, in terms of NOI, what we're seeing, what landlords are seeing, when I'm talking to people all across the country, we're seeing that income is raising, and it's raising pretty quickly. Some markets are 10%, 20%. Some markets are 35% higher year over the past 2 years. That's excellent for landlords. That's awful news, terrible news for renters, because that means the price is going up of rent. Now, expenses are also going up, but what I'm hearing from people, not at the same rate that income is going up. So that's good if you own property or are looking to buy investment property. The fact that NOI is increasing because income is increasing more than expenses. However, keep in mind that the debt service is also increasing now. So getting cash flow is still king. That is still the number one fundamental. And you're going to see operators who are not as seasoned, not as experienced in markets where the cash flow is squeezed, are going to lose their properties, unfortunately, because they're not able to understand that the cash flow statement is more important than your appreciation or your P&L. So I think a lot of seasoned investors are seeing that it's time to tighten up. It's time to make everything run more efficiently. It's time to reduce costs and expenses. And it's really time to try to keep people in housing. Our number one expense as investors, as landlords, is turnover. So we're trying to keep people housed. We're trying to keep people in place because that reduces the key expense. The second thing that's historically been the greatest way that real estate pays you is a loan paydown. So typically, your tenants, pardon me, your tenants are paying for your mortgage. Your tenants are paying for your mortgage plus a little bit more. That's the cash flow. That's how you stay in business as an investor. However, what we're seeing is the loan pay down is reduced. Sometimes we're seeing ARMs, which is a adjusted rate mortgage. Sometimes now I'm even considering using interest only payments on some properties, which would eliminate the loan pay down altogether. So I'm considering, and I know a lot of other people are actively using interest only loan products so that they can increase cash flow, which keeps their asset. But what it does is it eliminates that loan pay down. So typically, a loan of $300,000, you would pay off about $5 to $6, maybe $7,000 a year in principal. So when you go to sell that asset, you go to sell that house, you're essentially making $5, $6, $7,000 a year profit when you sell. Nowadays, that might not be an option, as we need to manage our cash flow with adjustable rate mortgages or with potentially interest only loans. So just something to keep your eyes out on that the loan paydown is shifting a little bit. The third way that real estate pays you is with tax benefits. Fortunately, these haven't changed a whole lot. Depreciation is still excellent. You can take bonus depreciation, 100% bonus depreciation, if you were to do a cost segregation study in 2022. Now that starts to reduce. In 2023, that's 80%. In 2024, 60, 40, 20. And then I believe it eliminates sometime before 2030. Don't quote me on that. Talk to your tax person or your cost segregation person. But basically, what this means is real estate is still an excellent way to reduce your taxes. All of your expenses from your NOI are going to be wiped out in your taxes. Also, most people own a property in an LLC, which is would be able to you can use those expenses to reduce your W-2 personal income taxes, which is great. So the tax benefits of real estate are still extraordinary. Nothing's changed there, other than bonus depreciation is going to start to decrease in 2023, something that's typically taken on multifamily, retail, commercial properties. The fourth, typically, the fourth way that real estate pays you is with appreciation. This is where the price of your house increases. Now, some people get hung up on this, but it only really matters at two times. It only matters when you buy the property. It only matters when you sell the property. Every other day, every other hour, every other minute in the middle really doesn't matter. A lot of times people look at their home values, and I see this mostly from people who only own their primary house. They don't even have any real estate investment properties. But people are very hung up on how much does my house cost? To be honest, and I don't mean to be rude here, but it really doesn't matter. Is if you're living in your house, it doesn't matter how much it costs you because you're likely paying the same monthly mortgage over and over and over. However, if you're doing a lot of transactions, if you're buying and you're selling a lot, it definitely matters how much you buy a house for and how much you sell the house for. In my earlier example, in 2019, the typical house in the United States was $300,000. Now it's $430,000. Holy cow. Appreciation went from being a lazy little icing on the cake to being the largest piece of the pie. What's more is when you add leverage onto that, it explodes your return. Typically, I should say historically, appreciation in the United States in the past 40 years has been 4% a year on the house values. So let's say $300,000 house goes up in value 4%. That means you've raised the property value $12,000. That's 4% times $300,000. And you sell it the next year for $312,000. You've made $12,000. But consider that you only had to put down $60,000 to buy that asset. So $12,000 that you gained in appreciation divided by the $60,000 that you put down, that's a 20% cash on cash return just in that one category of getting paid in real estate. That's exciting. That's excellent. And it's been exciting to own real estate and have investments the last few years because they've exploded. Some markets have gone up a lot. Some markets are on fire, and that's great. Some other markets are on fire, and it's making them not affordable. Other markets are going up considerably, but not on fire. And other markets are relatively stable. So it's interesting. Again, real estate is not a asset class. It's local. It's local. If you have a place in Cape Coral, Florida, it's going to appreciate differently than Indianapolis, Indiana, or San Diego, or right here in Minneapolis. They're all different. So each market is different. So take that with a grain of salt as I'm talking about this. So your 2019 appreciation might be 20% cash over cash. That's $12,000 divided by your $60,000 down payment. Now, fast forward to 2022, where we got a $400,000 asset. We had to put 30% down, so we've put 120% down. If we get 4% appreciation on that house, great. We've made $16,000, more than the $12,000 that we made in our prior example. However, that $16,000 we made off of a $120,000 down payment, which lowers our cash on cash return on the appreciation to 13.3%. Still excellent, but not quite what it used to be. So just another example of how the current market is shifting for real estate investors. Something to keep your eyes on as just something is interesting as how interest rates and loan to value can affect your uh, cash on cash return on your appreciation. Uh, Fifth way that real estate pays for you is a hedge on inflation. If you get a, let's say, 30-year locked in mortgage rate, and you're paying it off year one, year two, year three, year four, year five, year six, seven, on down to year 30, holy cow, that your payments seem dismal, downright easy to make payments on 30 years from now. Consider buying a house in 1992, 30 years from now. Boy, the cost of a, a Mountain Dew has changed a whole lot since then. The cost of gas, the cost of Starbucks. Was Starbucks even around in 1990? I don't know, but it would have been much cheaper, that's for sure. Everything is going up in price. So just as if everyone likes to report that if you have $100,000 in the bank and inflation is 8%, next year you essentially have $92,000 worth of purchasing power. The same goes for debt. If you have $100,000 in debt now, next year you have $92,000 of purchasing power debt, if that makes sense at all. So, what inflation does is it erodes away the cost of your debt. So, that's another way typically that people get paid for having real estate. So, again, historically, uh, people get paid with cash flow, loan paydown, tax benefits, appreciation, and inflation hedge. However, those fundamentals are still there. However, they've changed quite a bit. Now, I would argue that the number one thing is still cash flow. Cash flow is always king. It's always going to be number one. It will never change. Always keep your eye on your monthly cash flow. That's how you stay in the game. It's awful when you hear people talk about, oh, '08 wiped me out because I wasn't managing my cash flow. Oh, the dot-com bubble wiped me out because I wasn't looking at my cash flow. Please, please look at your cash flow statements. Make sure month over month you have more money coming in than going out. That's how you remain solvent. That's how you stay healthy financially. Uh, I would say that number two now might be an inflation hedge. Inflation is 8.5% according to the CPI. Some other areas that you may want to look are saying it's anywhere from 13 to 18 to 19%. Wow, that's really high. So if I can get fixed debt now and pay it off at a much lower um, dollar later, wow, that saves me a whole lot of money. If I have $100,000 in debt this year and only have to pay it off in $92,000 of 2023 debt, that's really a big advantage to having real estate. Like any other hard asset, all the precious metals, oil, farms, any sort of tangible asset is going to raise in price during inflationary periods. Money goes towards hard assets. So I think that lazy way that we got paid back in the day, that was a little icing on the cake, again, is becoming a wonderful reason to own real estate. The third reason now, I think, to have real estate investment would probably be the appreciation. It's certainly changed. I wonder if the heyday of the past few years has gone away. We're still seeing markets go up generally across the board. I think right now it's at 4% so far for 2022. Some markets are starting to see a recession. Other markets are going up slightly. Depends on who you ask. Some people think that we're at the bottom right now and prices are only going to go up because of all the shortages of houses that's out there, anywhere from 8 million to 12 million units short for what we need to house our population. Some people are saying we may lose another 10 or 15% because that was basically the bubble of 2021 that came in the latest stimulus checks. Other people are saying we could lose 20 to 25% of the costs. So it depends really on who you ask. The general sentiment in the investment world right now is it's a good time to buy. It's an excellent time to buy. It could be time to wait a few months to see what happens. But most people out there are saying this is an excellent time to buy. Interest rates have gone up. If they go up more, you would have been happy that you got in at a lower rate. If they go back down to the fours, to the threes, to the twos, great. You're controlling an asset that cash flows, and you can cash flow even more when you refinance. So I would say most people are looking at buying right now, even though you hear about in the news all the time a housing recession and all that kind of stuff. The fourth thing right now, I would say, would probably be tax benefits. They're still excellent. They're still excellent tax benefits. Wonderful way to reduce your personal income taxes. Wonderful way to legally pay no tax if you were to want to do that. And the fifth way right now is probably loan pay down. So let's move from the second biggest way that we get paid in real estate to probably the fifth, because we're not paying loans down as aggressively as before. And I'm strongly considering using an interest only payment. It seems foreign to me, but a lot of people that I've been talking to are starting to use them with some good success. And so it's something to look at. So just to recap, real estate pays you in 5 ways. It pays you with cash flow. Cash flow is king. It pays you in appreciation when the price of the house goes up. It pays you by paying off the loan every month, and then you recoup that and you get paid that back when you sell the property or 1031 exchange. You also have an inflation hedge. So your debt gets eroded with inflation and it becomes easier to pay off that asset. And then the last one is going to be um, tax benefits. So all those things are great ways to own real estate. I hope you strongly consider adding real estate investing to your portfolio. A lot of people like to do this actively, whether it's house hacking, where you move into a house or duplex. This is how I got involved in real estate investing. I bought a duplex. I lived in the basement. I rented out the top floor. Things were good. It was the first time that I got free housing, and it was excellent. You can get a triplex, you can get a quad, house hack your way into it. You can also try the Burr method, which is pretty popular way to do it, where you buy a house for cash, you renovate it, you refinance it, and then you rent it out. That's a popular way to do it. However, that strategy has shifted a bit now, so please look into that and do some research on it. People are also getting involved passively. So you are a busy professional. You have money that you want invested, but you don't know what to do or how to do that. There's a lot of seasoned operators out there who are happy to help you navigate how to do that. Myself included, reach out to me if you want, or I'm happy to get you connected to any one of my network of people that I talk to and work with quite frequently. So I hope this has been helpful for you. There's a whole lot of news out there about how housing is going into a recession and how prices are going to fall. There's going to be a collapse. Who knows what's going to happen? But what we do know is real estate is a hard asset. There's multiple ways that you get paid. People always need shelter. Very, very, very bullish, extremely bullish on housing going forward. My name is Chris Schweigel. I'm with Chris Connects. Thank you so much for your time and take care.